In today's Money Watch, we are talking about your taxes, so listen up. Most Americans have until April 15th to file their 2024 tax returns, pay any taxes owed, or request an extension to file. According to the IRS, 61.4 million tax returns have been received, and more than 60.7 million have already been processed. CBS News business analyst Jill Schlesinger is here. Good morning.
Good morning.
All right, so about 7,000 IRS employees were laid off last month in the Trump administration. They are planning for more cuts. Should we prepare for delays this tax season?
Well, I think the best way to avoid a delay is to file electronically.
Okay.
Use direct deposit, because if you're due a refund, that's the quickest way to get it. And the IRS has been pretty consistent. When you do that, you usually get a refund within 21 days of filing. However, and here's my asterisk, remember in COVID when there were so many delays? Those delays were usually about people who needed physical eyes on a return. So if you have a complicated return and it requires an actual agent or a representative from the IRS to look at it, there could be delays. So that is why this year, for the first time ever, I think I am saying, even if you owe taxes, I would try to get my tax filing done sooner rather than later, just in case.
Well, everybody looks forward to a refund. It's like fingers, eyes, legs, toes, crossed. Please, please, please. But we're hearing that the average refund is a little over $3,300. That's an increase from last year. Why do you think that is?
Well, it's mostly because of inflation. So when we have inflation, the IRS will automatically change certain things like tax credits, and they will also change the actual the brackets, not the tax rates, but the brackets get larger. But as you guys know, even though you all pray for a refund.
I know I heard from reliable sources, Jess Connor, you don't like tax refunds.
I hate them.
Why?
Well, I think that when you have a tax refund, you've got to reframe it. It's not like you found free money. It's that you've given Uncle Sam your money for a full year.
Yeah.
And you haven't been paid interest for it. So instead of that, I much prefer people have that money in their hands during the year. Because if you have that money during the year, number one, you can pay down debt, which is super important.
Utilize that money.
Number two, you might be able to earn interest on the money. Number three, you might be able to kick up the contribution to your retirement account. So if you get a big refund, one nice thing to do would be, hey, let me change my withholding. Let me hold on to my money during the year. You might be the most patriotic person in the world. Keep your money.
On the retirement account question, what's the difference? I always mix this up between an IRA and a Roth IRA.
This is the time of year when a lot of people are really going to make that decision. So a traditional IRA means that when you put money into the account, the money you put in does not get taxed. So you get a tax deduction today. Later in life, after you're 59 and a half, and you take that money out during retirement, that is when you are triggering a tax, okay? A Roth IRA, you're putting money into a retirement account that has already been taxed. So you don't get any tax deduction today. But for all the years that it grows, there's no tax that's due. When you take it out later in life, the Roth money has already been taxed. So what's cool about this is, especially if you're younger or you expect your income to rise, you've already paid your tax at a lower rate, and you never have to pay tax in the future. Another thing is, even if you make a lot of money, the reason why a Roth is powerful is that you know what your tax hit will be. And that knowledge can help you down the line when you're paying for Medicare and you're paying for your own retirement.
Knowledge is power. Jill is power. Thank you very much. We appreciate it.